Welcome back to Metal Market News. I'm Professor Harry, and today we're diving into a very honest, and perhaps controversial discussion within the precious metals space, because what you're about to hear challenges the traditional narrative that many silver-focused investors are emotionally attached to. As an independent analyst, my job is not to promote bias but to break down reality as it stands, and when we analyze the last 100 years of monetary history, it becomes increasingly clear that gold has consistently outperformed silver as a long-term store of value. Now that doesn't mean silver is irrelevant, far from it, but it does force us to rethink strategy, positioning, and expectations. What we're seeing right now in the market, particularly with the pricing dynamics of physical gold, collectible coins, and the gold-to-silver ratio, is revealing deeper structural truths about how wealth is preserved over time. And in this breakdown, I'm going to walk you through not just what's being said, but what it really means, and how I personally interpret these developments compared to the mainstream narrative, because there's a difference between understanding metals and actually understanding money. What stands out immediately in this discussion is the acknowledgement that gold, over the past century, has been a far superior long-term holding compared to silver, and that's not an opinion, it's an observation grounded in historical price performance and monetary behavior. Now, from a traditional silver enthusiast's perspective, this may sound uncomfortable, but as an analyst, I have to agree with the core argument, while also adding nuance that is often overlooked. Gold has functioned as a primary monetary reserve asset globally, held by central banks, trusted across borders, and historically used as a settlement mechanism between nations. Silver, on the other hand, while also monetary in nature, has increasingly taken on an industrial role, which introduces volatility tied to economic cycles rather than purely monetary demand. When I compare the two, I don't see silver as inferior, but I do see it as a different type of asset altogether, one that carries more upside potential in certain phases but lacks the stability and consistency that gold provides over long time horizons. The key mistake many investors make is assuming that both metals should perform identically, when in reality they respond to very different drivers. Now, when we bring this discussion into the current market context, the conversation around pre-1933 gold coins becomes particularly interesting because it highlights how pricing dynamics evolve as the underlying asset appreciates. Historically, these coins carried significant premiums due to their collectible value, scarcity, and historical significance, but as gold prices have surged into higher ranges, those premiums have effectively compressed or even disappeared in many cases. From a surface-level perspective, one might assume that this reduces their attractiveness, but I actually interpret this differently. When premiums collapse, it often signals that the base asset, in this case gold, is becoming the dominant driver of value rather than the collectible aspect. In other words, the market is prioritizing monetary value over numismatic appeal. My view aligns partially with the idea that premiums may return over time, but I also agree that this recovery will likely be selective, concentrated in high-grade, rare pieces rather than common coins. This reflects a broader shift in investor behavior, where newer participants are less interested in historical nuance and more focused on liquidity, simplicity, and ease of valuation. This generational shift is something I find particularly important because it influences how demand evolves over time. Younger investors, often referred to as stackers, tend to prefer standardized bullion products such as 1-ounce coins or bars because they are easier to understand, trade, and price. Pre-33 gold, while rich in history, introduces complexity in terms of weight, gold content, and valuation, which can be a barrier for newer participants. When I compare this with the traditional collector mindset, which values rarity and historical significance, it becomes clear that the market for certain types of gold is gradually narrowing. However, I would caution against interpreting this as a decline in value overall, because high-end collectibles will always retain a dedicated audience. The real shift is happening in the middle of the market, where common items may lose their premium appeal over time. The comparison between gold and silver becomes even more compelling when we examine historical ratios, particularly the long-standing relationship where 20 silver dollars were equivalent in value to a $20 gold coin. This ratio was not arbitrary, it was rooted in the monetary system of the time, reflecting the relative abundance and value of each metal. Today, that relationship has diverged significantly, and the question of whether it could revert back to historical norms is one that sparks considerable debate. From a purely mathematical standpoint, achieving a 20-to-1 ratio again would require a dramatic increase in silver prices, potentially pushing silver into levels that many investors currently consider unrealistic. However, as an analyst, I approach this question with caution because ratios are not fixed laws, they are reflections of underlying economic conditions. The industrial demand for silver, changes in mining supply, and shifts in investment behavior all play a role in determining where that ratio settles. While a return to 20-to-1 is theoretically possible, I view it as unlikely without a major structural shift in the global economy. That being said, silver does have a unique advantage that gold does not. And that is its extensive industrial use. From electronics to solar panels, silver is embedded in modern technology in a way that gold is not. This creates a dual demand dynamic where silver is influenced by both economic growth and monetary uncertainty. In periods of strong industrial expansion, silver demand can surge, driving prices higher, but in economic downturns, that same demand can weaken, creating volatility. Gold, by contrast, is less dependent on industrial use and more closely tied to monetary conditions, making it a more stable store of value. When I compare these dynamics, I see silver as a more opportunistic asset, one that can outperform gold in certain cycles but also underperform in others. Another critical aspect of this discussion is the concept of converting silver into gold, a strategy commonly used by experienced stackers. The idea is to accumulate silver when the gold-to-silver ratio is high and then convert it into gold when the ratio compresses. This approach requires patience, discipline, and a deep understanding of market cycles, but when executed correctly, it can significantly enhance long-term wealth preservation. I agree with this strategy in principle, but I would emphasize that it is not as simple as it sounds. Timing the ratio requires not only market awareness but also emotional control, because the best opportunities often arise during periods of extreme sentiment. When we shift the focus to the broader concept of money itself, the contrast between physical metals and paper currency becomes impossible to ignore. Historical examples, such as silver certificates, demonstrate how paper claims on real assets can lose value over time, while the underlying metal retains or even increases its purchasing power. This is a fundamental principle that underpins the entire precious metals thesis, and it is something I strongly agree with. Currency is ultimately a promise, while gold and silver are tangible assets with intrinsic value. This distinction becomes especially important during periods of economic uncertainty, where confidence in financial systems can be tested. Finally, when we consider the role of precious metals as a form of financial insurance, the argument becomes even more compelling. Unlike traditional insurance, which requires ongoing payments and provides protection against specific risks, gold and silver offer a form of wealth preservation that does not rely on any counterparty. They do not require a bank, a government, or an intermediary to maintain their value. From my perspective, this is one of their most powerful attributes, particularly in an increasingly complex and interconnected financial system. However, I would also add that not all forms of ownership are equal. Physical possession provides a level of security that cannot be replicated by digital or custodial arrangements, and this is an important consideration for investors. In conclusion, what we're really looking at here is not a debate between gold and silver, but a deeper exploration of how different forms of money behave over time. Gold has proven itself as a long-term store of value, while silver offers unique opportunities for growth and strategic positioning. The key is not to choose one over the other blindly, but to understand their roles within a broader portfolio. As an independent analyst, my view is that both metals have a place, but they serve different purposes, and recognizing that distinction is essential for making informed decisions in an increasingly uncertain financial landscape.